Hello, I'm Bernard Hickey from interest.co.nz and welcome to another in our series of double shot interviews. That's where we bring in someone who's got something interesting to say about the world, the economy, banking, whatever, and buy them a cup of coffee and have a quick chat. Today we've got Brian Branch, who is the CEO and President of the World Council of Credit Unions. Brian, welcome to interest.co.nz. Fascinating time in the world of banking and credit unions, building societies. The last 3 to 4 years we've seen the usual views about banks perhaps change. From your position, looking at the global credit union movement, how have credit unions come through the global financial crisis?
So for most credit unions around the world, this has been a time of going back to their values, back to their roots, back to their mission. And we've seen a lot of growth in the credit unions around the world. We've also seen some adjustments, some tightening of their houses. If we step back and we look at how large is this credit union sector, we have credit unions in about 100 countries around the world, about 53,000 credit unions, and they're serving about 190 million members all around the world. So here in New Zealand, the New Zealand Association of Credit Unions would be part of that system. There are affiliate, our member organization here in New Zealand. And in the early years of the global financial crisis, frankly, the credit unions did very well because they had not invested in many of the risky asset-backed investments. Most of the mortgages they had made to hold. And so credit unions did well during that initial period. And we saw a lot of growth as a lot of people came back to credit unions or looked to credit unions as a place of safety to put their savings. So we had a lot of growth. Credit unions continued to provide loans when many of their financial competitors had restrained their loans to the members, not just for consumer loans or for mortgages, but also for small businesses.
So explain for me, why didn't the credit unions get burnt by the toxic subprime debt when some of the listed banks did?
So for the credit unions, the basic model is that they accumulate, they pool savings from within their community, and then they make loans back out within that same community. So their mission is to provide services to that same community that they're serving. Now, credit unions eventually did get burned, like everyone else in the marketplace. With the recession, they saw in their households one earner or their member would lose their job, and so we did see increases in delinquency. We saw the value on homes fall, and so in some cases people had lost their jobs or the outstanding balance on their mortgage exceeded the value of their house, and they walked away from their homes. So we had big increases in delinquency and increased provisions costs for these credit unions.
Now, one of the comments that listed banks make is that they have easier access to capital than, say, cooperatives or credit unions. Was that an issue for credit unions in the last 3 to 4 years?
Yes, it has been, and it's constrained credit unions' growth in many countries in the sense that credit unions have to build their capital from the retained earnings. So they take savings, they pay interest on those savings, they make loans, they collect interest on those loans, and so their profit then it helps become part of the capital that they build up over time. They're not able to call capital from the general marketplace. And so as we saw a lot of people turn to credit unions, put their savings in credit unions, the capital to asset ratio became quite strained. And so to maintain strong capital reserves, quality, credit unions had to slow down their growth. And so while it was a great opportunity for more and more growth, credit unions had to work within the bounds of maintaining a good capital balance, and so that growth eventually slowed down. We also did have some losses. Credit unions are not always able to get all their liquidity out in loans, and credit unions pool their liquidity at second-tier level pools, and some of those second-tier level pools did have losses in the investment markets. And so credit unions had to recognize those losses as well. So they didn't get away scot-free. They did come through the markets in good shape. Today around the world we see credit unions growing again, still working with their ability to raise capital. And we see credit unions now getting into new areas of lending, which had been left by many of their competitors, and new opportunities for example, small businesses.
How, as the changes in regulations that we're seeing globally, particularly Basel III, how is that affecting credit unions globally?
So credit unions are affected like any other financial institutions, and to the extent that Basel III tightens up the definitions of what is considered Tier 1 capital, credit unions are facing that challenge, but it's also material they've been working with before. So they did not have access or did not use many of the previous exotically defined types of capital that others had before. So not a lot of change there. Also with higher capital requirements for things like securities investments, again, many of the credit unions focused on getting their liquidity back out in loans, and so they haven't been as affected by those changes as well. Credit unions are very focused on, building up their Tier 1 capital, their retained earnings. I think they've been more affected by some of the constraints and limits on fee income or interchange income that we see in some of the markets today. And so they've had to reanalyze their income streams. How much is interest income, how much is fee income, what's allowable and what's proper in today's market.
One of the arguments against credit unions in the past is that it was very difficult for them to get highly qualified, motivated staff because you couldn't give them shares and other bonuses to bring on board. Has that been an advantage actually in recent times, or is it still an issue for credit unions?
I think finding qualified staff is a challenge everywhere. I think we found very often in many marketplaces that the salaries for credit union staff lag a bit behind banking salaries, and so we work with a number of countries to make sure that they are doing good employment and compensation studies, analyzing the marketplace, and then putting in place a salary structure that offers the incentive for good staff. We do see some incentive programs in some credit union systems around the world. For example, the Brazilian credit unions have a very creative incentive program where everyone has a market-based salary base, but then on top of that there's an incentive program for all the employees based on the financial performance of the institution, its profitability and its growth. Haven't seen a lot of demand or calls for employee compensation packages that include stock options, things like that.
Maybe that's an advantage though, not having the sort of stock-based bonus systems that many say helped blow up many of these big listed banks.
That could be. Certainly with many of the consumer protection regulations that we've seen emerging in many countries, that's an area of constraints and regulations put in place now to look at sort of the long-run impacts of management's actions today, and rather than giving them stock options or bonuses based on performance today, looking at the impact further down the road.
Are we seeing the creation of new credit unions and building societies now? Because in the past, often credit unions and building societies, at least in New Zealand, have been quite old institutions, created, decades ago out of the union movement or in a different era. Is that era coming back, if you like, of credit unions coming out of communities from the start?
Probably not creating new credit unions. Today around the world what we see everywhere is more a trend of consolidation and merger. Very difficult for a small credit union unless it has a very well-defined, stable niche to compete in terms of offering the kinds of products and services that most consumers look for, and to have the kinds of efficiencies that they need to offer reasonably priced services. So rather what we see is a pattern of credit unions merging. We see probably about 300 mergers a year among credit unions in the U.S. And what they're trying to do is to have greater scale so that instead of all these credit unions investing in the same technological infrastructure, they have one pool of infrastructure that supports broader operations. What we are seeing is credit unions that become champions and innovators and leaders, and they get out in front of the crowd in terms of new innovative ways to provide services and to grow. And we see this all over the world.
Excellent. Brian Branch there, the CEO and President of the World Council of Credit Unions, here for the opening of the New Zealand Association of Credit Unions building in Auckland, and ahead of a discussion of political policies on growing cooperatives and credit unions in New Zealand. I'm Bernard Hickey from interest.co.nz. Thank you very much, Brian Branch. That was another in our series of Double Shot interviews.